Welcome back to part 2 of chapter 7, where we are now continuing upon our life of an asset. I have gone through the process of acquiring it. I've capitalized all the costs that were needed to get it ready for its intended use. And now I'm going to use the asset for a period of time. Okay. So I need to recognize something called depreciation or amortization if I have a tangible asset. So depreciation by a textbook definition or a dictionary definition is just a decrease in value or selling price of an asset. So we say as soon as you drive a lot off of a car, as soon as you drive a car off of a lot and you bought it new, that car depreciates because now it's not new anymore. So you can't sell it as a new car and you can't sell it for as much, right? Well, in accounting, we say that depreciation is the allocation of an asset's cost to expense over time. So we're saying we buy a car and we're going to use it for 5 years. Well, that car, as we use it, becomes less useful for us, right? As we put miles on our car, the usefulness that is still going to be able to be derived is going down. I'm not going to be able to drive it for as long. So we're going to say, hey, yeah, I have this total cost, and I'm going to use some of it in the first period. I'm going to use some of it in the next period, so on and so forth, right? To allocate out the usefulness of that asset as I am using it up and using the benefits of that resource, okay? So a really simple example of this is a local Starbucks pays $1,200 for equipment. Say they're buying an espresso machine with a service life of 4 years. So with what we've just talked about, how do you think Starbucks records depreciation expense for year 1? Okay, well, aren't I just trying to say it cost me $1,200 and I'm trying to allocate that over the time that I'm going to use it? So I guess I'll just divide by 4 and recognize $300 in depreciation expense. Yep, that's exactly what you do. Okay. The only thing that gets a little bit funky from a journal entry perspective is I recognize my depreciation expense of $300, but I don't decrease my equipment account directly. Okay. What I do is I establish a contra asset account called accumulated depreciation for the same amount. So I've recognized an expense, which decreases my shareholders' equity. Okay. And now I have increased a contra asset, which acts to reduce my total assets. So again, accumulated depreciation is a contra asset account. I do not hit my asset account directly. So from a balance sheet perspective, after year 1, how this is going to be presented is you're going to see equipment of $1,200. Now you're going to see accumulated depreciation, and they're going to tell you that there's $300 of accumulated depreciation for net equipment balance of $900. Okay. So again, because I don't hit the equipment account directly, that $1,200 stays on my books until I go through the process of retiring this asset. So we do make things a little bit more complicated than that if we have different factors at play. So the first thing that we saw was the service life, and we have to assign that. How long am I going to use this asset for? Then I have a residual value that you might also hear referred to as a salvage value. And this is if I think I'm going to be able to sell the asset at the end. So say I buy a car and I'm like, I'm going to drive it for 5 years. I think I'm going to be able to drive or sell that car for $5,000 at the end of this useful life. Well, that's a residual value, and I bake that into my calculation because I cannot depreciate something, right? I cannot depreciate something past residual value or salvage value. Then the last thing that we consider is what type of method of depreciation we're going to use: straight line, declining balance, or activity based. So this, we're just saying, what pattern of depreciation am I going to take? So we're going to go through all 3 methods using this same data, and that's that Little King Sandwiches is buying a new truck to use in operations. The truck is going to cost $40,000 with an estimated residual value of $5,000. I'm going to use it for 5 years or 100,000 miles. That's important because this is going to be important for straight line or declining balance. This is going to be important for activity based. Okay, so it's got to specify both so that we can go through and apply the appropriate method. So under straight line depreciation, we're going to allocate an equal amount to each year of the asset's service life. So again, I said we can't depreciate something past its residual value. So I'm going to have that hang out here in my numerator. So if you think about what we just said, I buy this truck for $40,000. I think I'm going to be able to sell it for $5,000 at the end of its useful life. And what is my useful life here? It's 5 years. So I divide by 5. So I have 35,000 divided by 5-year service life. That is going to give me 7,000 per year. So this is what we call a depreciation table. And I think this could be helpful because if you think about it, okay, I'm going to take under straight line depreciation the same amount of depreciation expense every single year. So I can fill out 7,000 in my depreciation expense every single year because I know, right, that that's what I do under straight line. So in year 1, I book this journal entry. Depreciation expense, $7K, accumulated depreciation, $7K. In year 2, I book this journal entry. Depreciation expense is $7K, accumulated depreciation of $7K. Okay. So after year 1, how much accumulated depreciation do I have? Well, I just have that equal to the accumulated depreciation that's going to be on my books, right? So year 1, I hit it for 7,000. Well, that's just what's in my balance. I've only messed with this account once in the year. So what is my total book value? What hangs out on my balance sheet related to this? Well, it's my 40,000 minus my accumulated depreciation of 7 gives me $33,000. Okay. But what happens to accumulated depreciation in year 2? Well, I hit it by another 7,000. So now all of a sudden, I have my 7,000 from year 1 plus my 7,000 from year 2 gives me 14,000. So when you calculate your book value, you could do it a couple of different ways. You could either say, I'm going to take my cost of my asset of 40,000 and subtract out my accumulated depreciation of 14, just like we did in year 1. And that is going to give me 26,000 bucks. That's how much is going to show up on my balance sheet related to this. Or I could say, well, I know I had a net book value at year 1 of 33 at the end of year 1. All I'm going to do is subtract out my current year depreciation expense and I'll get the same 26. It's totally up to you on what makes sense to you. Okay. So how much do you think our accumulated depreciation is going to be at the end of year 3? Well, I'm going to take what I started with and I'm going to add another 7,000 to it. So I'm going to have 21,000. And I'm going to do this every single year where I'm increasing that balance by 7,000. Okay. All the way until I get 35,000 in my total accumulated depreciation. Okay. And notice that's going to equal my total depreciation expense that I've taken. Those two things are going to equal each other. Now I can finish out my net book value by saying I have my 26 less 7 is going to give me 19,000. 19 less 7 is going to give me 12,000. And 12 less 7 is going to give me 5. So why is this important? Because now this is my residual value. So by keeping that in my numerator, I now have mathematically made it so I do not depreciate my asset past my residual value. Okay. So this under straight line is the same each year. I always am going to start with my original cost of my asset in order to do this. And I will either reduce the original cost of my asset by my accumulated depreciation, or I'll take my prior year net book value and subtract out depreciation expense. Either is totally fine. So straight line, I would say, is probably the easiest of the depreciation methods. Okay. It does get a little bit harder if you have a straight line or a partial year straight line depreciation. So instead, we're saying that Little King bought their sandwich shop or bought their truck on November 1st of year 1. So do I take a full 7,000 in depreciation expense in year 1? Well, no, I only use it for 2 months out of the total 12 months. So what I'm going to do is I'm going to start here and I'm going to say, well, I have 40,000 minus 35,000 divided by 5. That gives me 7,000 for a total year. And now I'm going to multiply it by the amount of years or months that I use it. So November through December out of my total 12 months in a year. Well, now that's going to give me 1,667 of depreciation expense in year one. So that's going to equal my same accumulated depreciation. And then my net book value is going to be 40,000 less my accumulated depreciation to get me 38,833. Okay. So what's my depreciation expense over here in years 2, 3, 4, and 5? Well, it's just going to be my 7,000. Okay. But over here in year 6, what do we think we're going to do? Well, I'm going to probably say, or I know that I'm saying that this asset is I'm going to not use it in starting November 1st of year 6. So I'm going to use it from January through November or to November 1st. Okay. So that means I'm going to take my depreciation expense full year of 7,000 and I'm going to multiply it by 10 over 12 when I use it for 10 over 12 months. So that's going to give me $5,833 in depreciation expense in year 6. So all you have to do is the same idea for accumulated depreciation and then net book value. We haven't done anything different, okay, with those. Really, the only thing that we've changed is the depreciation expense I recognize in the first and last year of use. The time that I'm using it hasn't changed. The only thing that's really changed is when I bought this asset, okay? So my accumulated depreciation, if you wanted to do the math here, I just add 7,000 each additional year that I go through the process of using it. All I'm doing is adding my 7,000 through these couple of years. And now notice, I will take my 29,167 plus my depreciation expense. What should this equal? Well, it should equal the total that I'm going to depreciate, which is my 35,000. Okay? Because my book value at the end should equal my 5,000 residual value. So if you go through the process, just like what we know we will do of taking my net book value less my depreciation expense, we're going to find that that exactly happens. Okay. So make sure you can do the math here to understand exactly what we're accomplishing. Okay. Because we are going through the same exact process that we did on the last slide. Again, the only thing that changes is these two periods, my first and my last period. Okay. So how much depreciation would be recorded in the first year for a delivery truck purchased on April 1st with a cost of 5 years and an estimated residual value of 5,000? Well, what's my annual depreciation expense? I have my 30,000 cost of my asset less my residual value divided by my estimated service life of, does it tell us, 5 years? So I have a total amount of depreciation of 5,000. Now, how much am I depreciating in this first year? Well, I'm depreciating 9 out of 12 months, right? Because I'm using the asset from April 1st all the way through December 31st. So I'm going to depreciate it a total of 3,750. Okay. So the next method that we're going to go through is called double declining. So I say double declining because that's typically what is going to be used. You might also hear it referred to as a declining balance because you can have a different factor in which, or a different rate in which you accelerate the depreciation. So before we get into double declining, remind ourselves what straight line was saying. Straight line depreciation was saying I'm using the asset the same amount every single year, right? Like I'm not going out and analyzing how much use I'm actually using in it on a yearly basis. I'm just saying I'm going to use it for a total of 5 years. And I think that it makes sense to put the cost of that use in each individual year equally. But some situations you're going to say, well, hey, I'm probably going to drive this car more when I get it and it's new, right? So I get this hot new delivery truck for Little King's sandwich shop, and I'm going to use this delivery truck more towards the beginning part of its life than in later years, right? Because in later years, it start having more problems. I need to replace tires more. I just don't drive it as much, okay? So what that means is I'm going to accelerate the depreciation that I recognize on this asset. So the double declining is going to shove a bunch of depreciation early on in the asset's useful life, okay? But what's important is the total depreciation is going to be the same, okay? Right? The total depreciation is going to be the same. It's just what period am I recognizing that depreciation in? And in order to calculate that, we have to have some sort of a depreciation rate. So it is double. So I'm going to put 2 in my numerator, and I divide by my total estimated service life here. So I think this is going to make a little bit more sense when we start looking at it for our Little King sandwich place. So remember, I'm purchasing an asset for $40,000, $5,000 residual value, 5-year life, okay? And in this case, we're saying we purchase it on 1/1 of year 1. Okay. So right now, when I first purchase it, I have a book value of 40,000. I'm just going to start with that super quick. Okay. And that book value is going to come over here and become my beginning book value. So what I end with in year 1 becomes what I start with in year 2. Okay. Now, under double declining, I have a depreciation rate of my 2 over my estimated service life of 5. That's going to be the same every single year. Okay, that never changes. So you could think about this as 2 over 5, or you could think about it as 0.04 or 0.4. So now all I have to do is multiply my beginning book value by my depreciation rate to get my depreciation. So all I have to do is take my 40,000 multiplied by my 2 over 5 to get total depreciation expense of 16. So my journal entry for year 1 is depreciation expense for 16,000, accumulated depreciation for 16,000. So when I think about my total accumulated depreciation T account, I've hit it for 16 after year 1. That's what it is in total after year 1. Then my book value, well, I started at 40, which is just my cost of my asset, and I've recognized depreciation expense of 16. So now I have a book value of 24. Okay. So what that means is this now shoots over and becomes my beginning book value. So I have 24 multiplied by 0.4 gives me 9,600. Wait a second, my depreciation is going down every year? Yeah, it is. Because I'm saying I'm using it more, decreasing the usefulness early on in the year or early on in the life. Okay. So what does my accumulated depreciation equal? Well, it equals 16 plus 9,600 equals a total of 25,600. So my net book value is now 1440. Pull that over. 14,400 multiplied by 2 over 5 gives me 5,760. I add that to my accumulated depreciation, right? And I can calculate my total accumulated depreciation of 31,360. I have a net book value of 8,640. That net book value becomes my beginning book value of the next year. And now I see that I'm going to have depreciation expense after multiplying it of 3,456. So I have total accumulated depreciation of 34,816. So I have a book value of 5,184. So what do you want to do? Well, probably what you want to do is pull this over and multiply it here. But you have to be careful. Don't multiply that. Do not multiply. Why? Because I am limited in my depreciation by the amount of residual value that I have. I can only depreciate this to 5,000 bucks. That's my residual value. Okay. So if that's my residual value, the math on 5,184 multiplied by 0.4, that would be $2,000. But I can't depreciate this anymore. I know I can only take depreciation up to a total of 35,000. So in my last year over here, I use this as a plug figure or a fill figure, okay, to calculate this out as saying, hey, I only have 35,000 in total accumulated depreciation I can take. As of the end of year 4, I've taken 34,816. So I can only take an additional 184. Again, that becomes a plug figure, okay? So be cognizant in the last year of double declining depreciation because that's when people tend to make mistakes. So the first year they like to make a mistake because they try to take and bake into account a residual value. That only happens, we only take into account the residual value in the final year that I'm using this asset. Okay. So be cognizant of that, right? I don't calculate residual value or bake that into my calculation at the beginning. I only think about it at the end. Okay. So at the end, depreciation expense in the final year is the amount necessary to reduce the book value down to my residual value. So how much depreciation should be recorded for the first year of for a delivery truck with a cost of 30, an expected service life of 6, and a residual value of 6? Okay, stop right there. Do I care about my residual value in year 1? No, I don't. Okay. So all I have to do is multiply this by 2 over my estimated service life of 6. Well, that means I'm going to recognize depreciation expense of 10,000 in the first year. Okay. So I will have depreciation expense of 10, accumulated depreciation of 10. So at the end of year 1, I have a net book value that's equal to 30,000 less 10 equals 20,000. Now, if I wanted to calculate depreciation for year 2, I would multiply that by 2 over 6, right? And so on and so forth to be able to calculate these things out. So the last method of depreciation that we're going to talk about is activity-based depreciation. And activity-based depreciation, I think, probably makes the most amount of sense to folks because here I'm saying I actually care about the amount that I'm driving this truck. I'm going to keep track of my miles, okay? And I'm going to depreciate it on a per mile basis. So that's for a truck specifically. I mean, that you could also measure it in terms of like outputs, pounds, barrels, whatever the output of this asset is. Okay. So we have to be given the amount that's used each year. So I have to know how many miles I'm driving this truck each year to employ an activity-based method. So think way back to the beginning of this video when we said we think that it's going to be 5 years or, right, 100,000 miles. Okay. So step 1 is to figure out my depreciation rate per unit. My depreciable cost is the cost of my asset of 40 less my residual value of 5. Now I'm dividing that by 100,000. Okay. So if you do the math on that, I'm going to get this weird decimal of 0.35. So what that tells me is I depreciate my vehicle 0.35 cent or 35 cents per mile that I drive it. So then I'm going to take that 35 cents and multiply it by my usage, right? My usage in that given year. So to see how that shakes out, we're going to work through the same example. We've just calculated our depreciation rate of 0.35. Again, that's the same every single year. That rate doesn't change. The amount of miles that I drive does change. And again, this has to be given to us. So to calculate depreciation expense, well, all I do is multiply these, right? So I have depreciation expense of 10,500 in year 1. I know that's all that I've hit that by as of year 1. So I can book my journal entry for year 1 if I so wanted to get this going. And then I could start my T account over here of my accumulated depreciation, where I've increased it by 10,500. I know that my book value is 40,000 less my accumulated depreciation. So I get a book value of 29,500. In year 2, I take depreciation expense of 7,700. I add that to my 10,500 for total accumulated depreciation of 18,200. So I have a book value after I go through this process of what? 21,800. I take depreciation expense of 5,250. Add that to my accumulated depreciation for a total of 23,450. I have a net book value of 16,550. Year 4, I have depreciation. Oh, check this out. I drove it more in year 4. My depreciation can go up. That's totally fine. So I have 7,000 for a total accumulated depreciation of 30,450 and a net book value of 9,550. Okay. 13,000 multiplied by 0.35 should give me 4,550. What should my accumulated depreciation be? Well, it should be the 35 to make sure I don't depreciate this past my residual value. So because I took into account my residual value when calculating this over here, I will mathematically never reduce it past my residual value. Okay, so I think a lot of students find activity-based to be the most straightforward because it's actual usage here. The reason a lot of companies don't use it is because think about how many delivery trucks a company like Amazon has. Are they really going to keep track of every single mile driven on every single truck? Yeah, probably not. It's not super practical. So a lot of the times companies will use like straight line or double declining and just allocate it out systematically as opposed to trying to keep track of every single mile that every single truck drives. Okay. So notice under the 3 methods, they all even out at the end of the day. The total depreciation is going to be 35,000 taken over. It's just recognized in different years, right? So under straight line, I take the same amount of depreciation the whole time. Under activity based, right? Well, I kind of have these juts where sometimes it goes up, sometimes it goes down. It depends on how much I drive it. And double declining, I recognize a bunch of depreciation early on and less as the asset goes through its useful life. So here you can see my accumulated depreciation balance always goes up, right? Like it needs to increase under every method because I'm accumulating the depreciation that I'm recognizing and I keep recognizing more depreciation. It's just how much it's going up by is changing because the amount of depreciation that we're recognizing is changing. Okay. So finally, here's Lululemon. They have a disclosure here on how they take depreciation. So it looks like most buildings are depreciated on a straight line basis. Leasehold improvements are depreciated on a straight line basis, and they give us our estimated service life. But other equipment are used with a declining balance as follows, and it gives us the respective percentages. So I know it's easy to get lost in all the different calculations and computations and journal entries. But again, remember, this information is important for investors and creditors to know and understand so that they can make good decisions based on the information that is provided. So with that, that wraps up our conversation about depreciation expense. Lastly, we're going to end, right, with how an asset is disposed at the end of its useful life. So I will see you then for the last topic over long-term assets.